Is the AI bubble about to pop? It might be the most expensive question in the market right now. AI stocks drove roughly 80% of the market's gains, a handful of companies now worth trillions. Some of the smartest investors alive are split down the middle. Even the CEO of OpenAI has openly said, yes, there's a bubble, while raising money at ever higher valuations. So who's right? Instead of picking a side, let's do something more useful. Look at the actual warning signs, the actual counterarguments, and exactly what you should watch to judge it for yourself. First, what even makes something a bubble? It's not just high prices. A bubble is when prices climb far beyond what future earnings could realistically ever justify, when the story outruns any believable math. By that definition, the AI boom has some genuinely alarming features. And the one that keeps serious analysts up at night has a name most people have never heard: circular financing. Here's how it works, and why it matters. Nvidia, the chipmaker, invested up to $100 billion into OpenAI. OpenAI then uses that money to build data centers filled with Nvidia's chips. So Nvidia funds its own customer, who spends the money buying Nvidia's products. Money flows in a loop. And it's not just those two. Microsoft owns a big stake in OpenAI and sells it cloud computing. Nvidia backs a cloud company called CoreWeave and guarantees to buy whatever capacity it can't sell. One Harvard professor put it bluntly, in some cases, it looks like Nvidia is effectively paying its customers to buy its products. The danger? A sale you financed yourself is much weaker proof of real demand than a customer spending their own money. If the outside demand isn't as strong as it looks, this loop can run in reverse fast. Which brings up the comparison everyone reaches for, the dot-com bubble of 2000. The parallels are real. Back then, internet companies bought equipment from Cisco's revenue soared, that justified more investment, and the loop inflated valuations until sentiment reversed and the Nasdaq fell 78%. Same circular structure. And there's more. An MIT study found that 95% of enterprise generative AI projects were delivering essentially zero measurable return so far. Another study found 90% of firms reported no productivity impact from AI at all. If the spending is enormous but the payoff is invisible, that's the textbook setup for a painful correction. But here's the other side, and it's genuinely strong, which is why this isn't a simple story. Serious institutions like Fidelity and JP Morgan have looked at the same data and concluded this is not obviously a classic bubble. Why? 3 reasons. First, unlike the dot-com era, today's AI leaders are wildly profitable: Microsoft, Nvidia, Alphabet, with real revenue and deep cash reserves, not just pitch decks. Second, and this is the key one, in 2000, companies funded their spending with borrowed money, with capital expenditure hitting nearly 4 times their free cash flow. Today, they're largely spending what they earn, that ratio is below 1. Debt-fueled bubbles pop violently, earnings-funded booms deflate more gently. And third, the revenue is real and growing. Anthropic went from $1 billion to over $30 billion in run rate revenue in about 15 months. That's not imaginary demand. So where does that leave us? Honestly, in the messy middle, which is the truthful answer, not a satisfying one. Even Jeff Bezos called it an industrial bubble. A lot of money will be wasted, plenty of companies will fail, but society may still inherit transformative infrastructure, the same way the dot-com crash still gave us the modern internet. The technology can be real and the valuations can be too high at the same time. Both things can be true. The question isn't genius or catastrophe. It's whether the financial structure can hold long enough for the real demand to catch up to the spending. So what should you actually watch, instead of guessing? A few concrete signals. 1. Earnings season. Watch whether AI companies' actual profits justify their prices, or whether the gap keeps widening. 2. That circular financing. If one big data center player fails to refinance its debt, the loop can unwind and that's your warning shot. 3. Enterprise adoption. Does that 95% no return number improve as companies learn to use these tools, or not? And 4. Concentration risk. Because AI drove most of the market's gains, a correction in just a few names could drag down your whole portfolio, even index funds, so know what you actually own. So, is the AI bubble about to pop? The honest answer is, nobody knows, and anyone who tells you they're certain, in either direction, is selling something. The warning signs are real. So are the counterarguments. What you can do is stop reacting to headlines and start watching the fundamentals: earnings, financing, adoption, concentration. That's how you navigate a moment like this without getting swept up in the hype or the panic. This is educational, not financial advice. Always do your own research. If you want the clear-eyed version of these stories, subscribe.